It's the 28th of March 2012, and in this Boardroom Talk special podcast, Gareth Stobie, head of Grindrod Capital Markets, is with us in studio on a day when a new exchange-traded fund has been launched by Grindrod. We'll get into that in a moment, but there are now over 60 exchange-traded funds in South Africa. It looks like people are cottoning onto this idea, Gareth.
Well, certainly the issuers are. There have been a whole cluster of new products brought to market just of late. Market cap wise, I think the JSE and the role players would like the index, well, the suite of ETFs to be bigger than it is already. But certainly from a growth point of view, we see it as the way of the future. And we think more and more products are going to be listed on the JSE. If you look at comments from Nikki Newton-King, for example, she's very positive about the growth of the ETF sector on her bourse. So we're embracing new technology, and we think it's an exciting space to be playing in.
Oh, it's over 30 billion rand invested, and we've come a long way from the Satrix 40, which I think a lot of people will know about. Umbrella funds, in other words. Just explain what an exchange-traded fund is.
Sure. Well, basically, it's one security that trades as a share on the exchange. But by buying that one security, you get exposure to a whole bundle of underlying securities. So in our example, you're buying one security called Prefix, which has exposure to 17 other securities, being the whole index of exchange-traded funds.
Of preference.
Sorry, of course.
And it's interesting, it's primarily, I was having a look at it, primarily the bank's pref shares.
That's right.
So if you take Standard Bank, Absa, Nedbank, FirstRand and Investec, those five banks, and you buy their individual preference shares, it would be 75% of the portfolio.
That's correct.
Or making up the exchange-traded fund. Why should someone rather buy an ETF, or your ETF, the Prefix as you call it, than these individual preference shares?
Well, there are a number of answers to that question. I think the one is that 25% that you didn't talk about does give you quite a nice yield pickup. There are quite a lot of corporates issuers, the likes of Imperial Group, Steinhoff, that pay a much higher yield than the banks would pay. Secondly, you're taking away a massive hassle factor for an investor who only wants, say, 100,000 Rand exposure to the asset class. To pick and choose 4, 5, 6 different preference shares, there's brokerage, there's all the costs and complications that come along with doing this. Here, you simply invest in one security and you get access to the whole portfolio. Very much like Satrix 40, where you buy one share and you get obviously exposure to the top 40 companies. Much the same way you could go, I guess, and buy each of the top 40 companies in their constituent weightings. But here it's far more efficient.
And it's specifically preference shares.
Correct. Specifically preference shares. I think some of the other benefits that we bring to the party, preference shares have battled with liquidity in the past. They're not the most liquid asset class. We have put some of our own capital behind this project, so we're going to be market makers in the security.
What does that mean?
That simply means that if a client wants to buy the ETF round about the NAV of the security or sell it round about the NAV, we're willing to make a market and be on the other side of that particular
So making a market means there's liquidity. That
Correct.
means that if I want to buy or sell into this exchange-traded fund, I know that I can do it almost immediately.
That's right.
It's interesting the relationship you've got with EFT South Africa. That's Mike Brown,
Correct.
the old Satrix
That's
guy,
right.
where you can invest into this exchange-traded fund for only 300 Rand a month or 1,000 Rand lump sum. That brings it into the ambit of most investors.
Correct. And I think, Mike is a great spokesman for the development of the ETF market here in South Africa. He was, as you say, behind the Satrix development. And we consulted a bit with him in developing this product. And as you say, his platform in particular, ETF SA, allows retail investors to access that market more easily. A lot of retail investors might not have, for instance, an online share trading platform. They might only want to invest 500 Rand a month or do that type of investment plan. And Mike can facilitate all of that.
The fees are pretty low, and that is a big advantage of exchange-traded funds. What are you guys taking out of this?
Our total expense ratio will be between 0.45 and 0.5% per annum.
So that's about 0.5%.
Correct.
Half a percentage point.
Correct.
So you get 99.5% of what you invest actually goes into the investment rather than commissions, etc.
Except that it's not taken up front. So your full 100 Rand gets invested, and that 0.5%, as you say, gets taken off the value of the income in actual fact over the course of the year.
Gareth, it sounds great, excepting you have to wonder, did you plan this before the budget? Because the budget did take away quite a lot of the allure of preference shares.
It did and it didn't. The preference shares that the ETF is investing in had contractual protection for changes to the tax landscape. So prior to the budget speech, all the issuers that we were interacting with on the JSE who have listed preference shares had promised to increase the dividend yields by their STC savings. So in other words, increase the dividend yields either by 10% or 11%, thereabouts. So going forward, all those dividend yields are going to increase by 10%, but now the tax is going to be 15% and not 10%. So what I'm getting to is the dilution at the end of the day is quite marginal. It comes out to about 0.25%. And my argument really is that there are a lot of high net worth individuals in South Africa paying a lot of tax, the marginal tax rate being 40%. So even a 15% tax on dividend income is still tax efficient relative to paying, say, 40% on interest income.
So what kind of return would you be anticipating for investors in this new exchange-traded fund?
The yield at the moment is anticipated to be 7.5%. So that's gross of this new tax and gross of that 0.5%.
So you would still have to knock off 15%.
Correct.
So
Correct.
another 1%.
Correct. So you come out slightly over 6%. And
doesn't sound too good. It sounds pretty low.
Well, except that if you go into money market fund, you're earning 6% taxable. So now if your tax rate is 40%, all of a sudden you're down to, say, 4%. So now you've got quite a big pickup in after-tax income. And that really, therein lies the benefit, because from a capital point of view, yes, money market funds, your capital is effectively guaranteed. Preference shares, your capital does fluctuate, but within a very marginal band. And there's plenty of sort of back data that proves that they're fairly risk-averse investments. In fact, over the last 4 years, which have been horrid times in the market, as you well know, preference shares have been a standout performer, a standout asset class, which for me highlights their defensive characteristics. So you have this great defensive hedge, yet you have an income that is way higher than money markets after tax.
You're not competing with shares. In other words,
No, we're
Satrix
not.
40 is a completely different type of investment.
Correct.
You're competing directly against money market
Correct.
and income funds.
Correct. And in fact, I'd go so far as to say that we're also not competing with Satrix Divi either, which is also markets itself on a high dividend yield. Here, you're really saying to a client, right, you've got 100 Rand to invest. Most money managers will say, well, look, let's put 60 Rand in equities, put some in property, put some offshore, but we need a small cash allocation, bonds and cash, to give you a good income requirement.
And defensive.
Defensive, exactly. So we would put preference shares in that box, but with the caveat being that you need to benefit from the tax efficiencies of the dividend yield.
What happens if interest rates generally were to rise? What happens to the capital value of these underlying investments, the Standard Bank preference share, the same thing from F&B, etc.?
Well, all of the yields are linked to the prime rate. So if prime increases, I doubt prime's going to move tomorrow during the MPC, but if prime moves one way or the other, the dividend yield is going to track the prevailing interest rate environment. So we have always argued that because it's a variable rate instrument, your capital value shouldn't actually have to move at all with prevailing interest rate environments. Yields go up in the market, your dividend yield will go up. Yields come down.
So you're not going to lose any
No.
of your capital if interest rates go up, which you would do in, say, a bond fund.
Correct. I mean, things that drive capital valuations is simply demand and supply factors in the market. If there are more buyers of prefs than sellers, then obviously that's going to chase prices. If there's a particular concern around a company in the index, then that price will come under pressure relating to that particular company and its ability to pay the dividend on its preference share. Then obviously that'll affect prices.
I had an interesting chat with a director of a UK operation in the past week who knows South Africa well, and he said during the 2007 financial crisis, you could buy preference shares in some of the top South African names, and he said SAB Miller, Investec was one of them, and so on, at unbelievably high yields. Sasol was another, because of the sale by investors of pretty much everything. Are you going to look into those areas around the world where there can be, from time to time
Pockets of opportunity.
pocket of good opportunity.
Look, certainly some of the people who did the best out of that whole financial crisis were those that went into the high yields income environment with good counterpart names like you talking about SAB and Sasol. In the preference share market, this is purely a local story. We're tracking the JSE preference share index. So the 17 companies that we're investing in are all locally based firms, and we're following the index rules very well.
So there's
completely.
no ability to do that. It is the J251, as you call it, that
Correct.
index.
That's right. That's right. I mean, having said that, during the financial crisis in 2008, preference shares did come off. During October that year, I think they were down 5-6%, but then the following month they recovered straight back again. So, as I said earlier, very defensive asset class, proved it during that year in actual fact. But during that year, there were also pockets of opportunity to pick them up at particularly high yields.
What is your typical investor going to look like?
Typical investor is someone who is paying a lot of tax on interest income.
So it could be a retiree or a high net worth individual.
Correct. Funny enough, one of the new parts of the market for the preference share market are those funds that don't have to pay the new dividends tax. So there are well, they're not new, but pension funds and retirement funds who don't have to pay this new dividends tax. So they're actually going to get that yield gross of the tax and not have to pay any tax. So they may benefit as well.
So pension funds will get 7.5%, private individuals about 6.5%.
Correct. That's right. So they're individuals who've got a core cash component in their portfolio, but are paying tax on the interest income on that cash.
And it's your first exchange traded fund at Grindrod.
Yes, and like I say, we're obviously very excited about it. We think preference shares in particular is an interesting space. We look forward to seeing how it goes.
How big are you anticipating? What are your targets say in the first year? How much money will you bring in?
Well, we've started, it's an open-ended fund, and meaning that we can grow the fund as investor demand dictates. So today, for example, the fund's got a market cap of 12 million, but that's completely scalable.
That's what you guys put in, and it listed today.
Correct. So we would love it to be 500 million to R1 billion assets under management. That would be a nice size product.
Is there that kind of appetite?
Certainly. I mean, the preference share index has got 30 billion under management currently. Well, that's the total market cap of the index. Of that, probably 80% of the index is held by that typical investor I've just described, the high net worth individuals. And so this is merely productizing and making investment into the asset class that much easier. So we're certainly confident that can be achieved.
Would you be competing with retail bonds?
Yes, we would be.
And how does your yield compare?
I don't have the retail bond yields at hand, but there we would be simply looking at what the pre and post tax yields are, and we would definitely come out high on after tax basis.
Gareth Stobie is the head of Grindrod Capital Markets.